Hey everybody, this is Dimitri Pergamonic with MarketChameleon.com. I wanted to show you how to use a filter on the option block trade screener, which you can find right here. And the option block trade screener are large option blocks that are traded throughout the day, and this is a list of all of them right now, over 38,000. And one of the filters I think is useful is looking for unusual trades as far as the price is concerned. So we know that option prices can be converted to the implied volatility, and the implied volatility is a way we could measure how expensive or inexpensive option premium is. The higher the implied volatility, the more expensive the option is. The lower the implied volatility, the less expensive the option premium is. And when we use the implied volatility percentile rank, this allows us to measure how the current implied volatility is relative to the historical implied volatility. And I'll show you an example of it. But basically, the higher the implied volatility percentile rank, the more elevated the implied volatility is, and the more expensive the option premium is. The lower the IV percentile rank is, the less expensive the option premium is, and relative to the historical level. So let's just use this filter over here, the IV percentile rank, and we're going to look for implied volatility that's elevated, and let's say in the 90th percentile or higher. So over here right now, we narrowed it down from 39,000 to 1,122. Let's also look for option trades that they're not part of a spread or a contingent trade or part of a hedge with a stock. So now I use that trade condition to look for just auto execution, intermarket sweep, or regular orders. And let's see how much we narrowed it down to, 722. We could also narrow down a little bit further. Let's see if this implied volatility is due to perhaps an earnings coming out. So let's take out any stocks that had already reported their earnings in the previous, let's say, 30 days. So all of them disappeared, so a lot of these can be earnings related. I'm just going to put that back because nothing appeared here. And if you wanted to scroll over here, you could see any type of potential catalyst events like earnings coming up or company events over here that could be causing that implied volatility to be elevated. And just to take a look, what does this mean, the 98th percentile, 93rd percentile? Let's just pick one out of here. Let's just say the July 19th RIG call. Right now it's saying it's in the 97th percentile, 61.8 implied volatility. I'm going to click on that to go to the options chain. And when the options chain loads, we see over here, this is the July 19th 6 call, which is over here in the 97th percentile rank. Let me just close this really quickly. Let's bring up what this actually looks like historically. This solid orange line over here, that's where the implied volatility is right now, around 62. This makes it a 97th percentile. 97% of the historical observations fall below the current level. As you can see, here's a few that were above that level. Here's the average implied volatility for a similar option with 22 trading days to expiration and 2.3% away from the spot price. Here's the minimum and maximum implied volatility, the range historically, and then the median implied volatility. And if we wanted to just take a look, what does that translate into dollar terms? We could go back and see, well, how far away is this price relative to if the implied volatility was back at its median level. What we could do here is these are the theoretical levels in the middle, and let's just set that all the implied volatilities, the theoretical implied volatilities, to the historical median, and we're going to rerun that theoretical value, and then you could see if it was reverted to or was at that median level, this option would be worth 24 cents. Right now it's 38.39. So in dollar terms, you could see how far away now it deviated from that median level. Hopefully this was helpful. Thanks for watching. See you next time.